Welcome everybody to another meetup of Eindhoven Financial Independence. So my name is Peter. I'm the organizer of this meetup. We meet every 2 weeks. We talk about various topics on personal finance, like optimizing your budget, saving money, investing in stocks, bonds, real estate, those kind of things. Today we're gonna dive deep into company financials. We're going to look into income statements. We're going to look into balance sheets. We're going to look into cash flow statements. So these are all the fundamentals that you need to know to be able to assess the value of a company. And our member Shashank, he will give this presentation. So Shashank has a background in applied mathematics and also controls theory.
Yeah.
You work as a controls engineer, I assume, right?
Yeah.
Yeah. And you've been a member of, he's been a member of our group for about 1.5 years now, so almost since the beginning of this group. And I think it's going to be a very interesting presentation. I hope you will learn quite a bit today. The way it works is that we will have about 45 minutes to 1 hour of the presentation. Then after that, we have a Q&A session, so only the first part will be recorded. If you want to ask a question, just please raise your hand. I'll pass you over the mic so that we can get a better recording. And you can have the floor now.
Yes. Thanks.
Yeah.
Yes. So thanks, Peter, for that introduction. It's basically the theme of today is Layman's Introduction to Corporate Finance, and I put Jordan Belfort there. While I was cycling, I thought I should put the accountant, to be very honest. So let's. I'd like to keep it a little more with a lot of discussions. I believe no question is stupid because I'm eternally stupid. So I think it's good that we have some sort of interactive sessions. So please feel free to ask, because even I'm also learning as much as you guys. And let's try to understand where we come about in this. So about me, as you just said, came to Eindhoven like 5 years back. I studied here, and now I work as an engineer here in Eindhoven. And I joined this meetup somewhere in 2022 when it was in the station.
Yeah.
On top of the cafe in the station.
Coffee lab, yeah.
It was a small. I still have the photos from that. So it was my introduction into something where, let's say, me learning a little more into personal finance, which I think is an important topic for all of us. And unfortunately, it's not something that we get taught in school. At least for me, it wasn't. So it was nice to have this sort of group here. And so basically this talk came about because last year I've been talking to Peter about, hey, how can I contribute to this? And I identify as an engineer who likes to know a little bit about the business. So that's where I attended the Finance Basic Show workshops that happened inside my company, also a little bit outside of the company as well. And I tried to summarize most of my learnings from that workshop and put it into a presentation. But before we start, how many of you people have a background in finance? How many of you use financial statements, account statements in their daily, day-to-day job to go about their tasks in any form or manner within your company or outside your company? You probably have your own company, or just to get a feel of the audience here. Just feel free to speak up. No? Okay.
But can you also explain a little bit of finance basics workshop, where it happened, how people
Yeah.
can join it? For example, if I am interested, how I can join this?
So this happened within my company, but also PwC. The accounting firms usually give out the top 4 accounting firms: PwC, Deloitte, KPMG, and all of that. They usually give out these accounting basics workshops that you can subscribe to. Just look out their website. I think the one that I attended was from one of these big fours. And one of these big 4, they call the big 4 firms. Yeah, accounting firms which usually people subscribe to. Why? Because they play a huge role in auditing for big companies. So how it works is, as any organization, you have profit and sort of loss. You need to have your finances in check, because that's something, either you have an internal audit committee within the company that does audit checks, or you can also get services from these accounting firms usually. The Big Four is something which are, of course, there are so many other accounting firms.
And is the service free or?
No, no.
Okay.
You pay, I think Big Fours they bill you based on your returns. Sorry, bill you based on the, let's say, I'm not particularly sure of how it works individually. I had a family member who worked for one of these accounting firms. So they take a percentage of a commission usually.
Okay.
And it's, but these professional services are given because I'll tell you why as well, why these services are given and why it's an important part in our financial system as well, also for publicly listed companies. But yeah, so that's sort of, okay, so everyone is more or less in the background of, let's see where it goes. At least, okay, what to not expect from the stock, so let me set the tone clear here. I don't give investment advice. Investment advice is something which is purely something that is very particular to your personal situation and so on. And this is purely educational. We don't, at least I don't give any sort of advice. And I also tell you why you should not rely on financial statements purely for investing in stocks. So before I go there, does anyone have an idea of what financial statements are? Okay. He also has. Okay. Can you tell me what do you think financial statements are?
So every quarter company reports out on what they have done, their inventory, how much inventory they have, how much they sold, what is the profit they made, what are the losses and other things. And based on that, you project your EBITDA, profit and loss over time, and based on that, the stock prices moves. And if they are really doing well, the market predicts something, and if you are exceeding the expectation, you have better movement in the profit stock price. Or if it's otherwise, it also punished based on the financial statements.
Yeah, so that's precisely what it is, but I want to hit some disclaimers here, if I may, respectfully. The cadence of financial reports can be quarterly, can be monthly, can be annual as well. So financial statement is a basket term for any organization. And as you rightly said, it's basically trying to give what has happened within the business perspective. But I also want to say stock price, stock manipulation or stock price fluctuation can be, of course, during quarterly reports, but it's also other factors also that drive stock price fluctuations. But you're right, projections are usually given and so on. So to completely summarize from a very basic fundamental perspective, it is your report card. It is the company's report card. I think we've all been to school. It is the report card of what went inside the company, what came outside, how are they doing, and basically it's a proof record of how this company is operated financially. And yeah, so that's how I would summarize. Do you have a better explanation?
I think that's pretty good for now. We will see more details as we go on. Yeah.
So the financial statements are for private companies, also for public companies. So any organization, even non-profits also sometimes give out financial statements. But there are different regulations for non-profits and profits. And for-profit companies, which I'll focus on, which are publicly listed companies, are mandated to give at least, to show their financial statements for an aggregate of 3 years, at least before they get listed, and it has to be audited based on certain rules. This is how, let's say if, take an example of, I take an example of NVIDIA here, or if any other company, for example, in Eindhoven, let's say ASML, it's a dual listed company. It has to release its financial statements after the fiscal year. It has to, they release it in quarterly cadence as well. And during this time, they of course adjust the financial projections they've given in the previous year. They give you a report as to how they've done in that particular quarter. And it's basically also a way of publicizing their report card. So they do press releases, which you might have seen. They do, they also, a lot of noise also comes around the quarterly reports usually. And this is something that media likes to pick on a lot, but basically that's for us to understand how they have done in a particular quarter, because we as an investor are someone who's outside the company. We don't have knowledge. Yes, you might have regular news, but you don't have knowledge into the basic day-to-day operations of a company. So this is something that could help you, but again, investments come from a broader perspective as well. Yes? And yeah, why don't you rely only on financial statements for buying stocks, as my previous statement? It's purely historical data. It's purely based on how they did. They will project a certain value, finance projections on what they think they are going to get, let's say their turnover, and they adjust it through the quarter on a quarterly basis. And they also give a guidance on where they expect the gross profit margin to be, but there is no guarantee on the future performance. There cannot be. It's something which you always take with a risk, because nobody can expect certain profit percentages few quarters down the line. It also doesn't tell you the economic and business climate of a particular sector. For example, geopolitical tensions, war, these are things that you cannot predict. And also, a stock price is also, there's a qualitative aspect to the stock price, also depending on the leadership strength over there, the CEO, the brand name that it has in the market, the strategy that they're going to take for the coming future, and how does the industry look for that particular sector. So this is something that how stock prices also go based on. I'll give you an example that I've picked out, but that's something we'll come to. But that's how I'm saying that these are all inputs that goes into a financial analyst who makes projections and delivers it to probably traders, retail traders, or big hedge funds, and they make decisions based on whether we should. This is one of the elements of fundamental analysis, stock analysis. Is it fair to say that?
I think so, yeah.
One of the elements of fundamental analysis for a company, which is something that we usually do. Investors want to understand how this works, and not just, it's most of it is trying to put a sense of the chaos, is what I would say this is what financial statements do. So future risks are also usually given. So there's a risk committee usually involved in all businesses, and they tell you the operating risks that they foresee in operating in that particular business environment. But they will never tell you the operational challenges that's going to come. Or they could project, but you can never expect it to be certain. So that's why you don't rely only on financial statements to make your stock decisions.
Maybe we could say that like value investors, they put a lot of primacy on fundamental analysis.
Yes.
So by being able to understand these statements, you can determine the book value of a company, and then you can compare that to the market price, and then you find these price to book ratios, and it helps to tell you whether a company is overpriced or underpriced, and then value investors will focus more on the companies that are underpriced.
Yeah.
But doesn't mean that it's still a fair price, but indeed.
I get what you're saying. I would like to add, do you think you can add an example to it? I have an example in mind. I'm not sure if it's like an overpriced company that used to be was, again, I'm carefully say this, Like, I think Tesla is something that could be seen in that. See, based on media outlets. Again, I'm not the person who did the analysis for this, but again, if you see the business behind it, the branding that comes with it, and nobody can say it's perfect or not, because yes, there is also the element of who determines the stock price is not something that's set by someone. The market determines it at the end of the day. So that's why I'm saying, like, as he rightfully said, value investors, you have a set of instruments and tools to do this, basically. Again, I don't mean to hurt anyone's sentiment by, so basically, investors are people who have funds with them, and who want to basically help a business for their own returns. And you as an investor can start your own business or fund it to another company, and they run the business for you. And investors try to get as much as in importance, and that's also what the previous statement he said, value investors try to get as much information as possible from your company. And yes, your company top management is actually accountable at the end of the day. The directors, the top directors usually are accountable to the investors based on how they perform. And accuracy, if you're a publicly listed company, the goal of this financial statement at the end of the day is transparency. One of the goals is basically transparency, both from the outside public as well, because there's public invested money in it, but also for internally, for them to make better decisions on where to go, how good are we in terms of the books. And these governmental agencies usually play a huge role here in terms of auditing and checking if the proof book is correct or not. I mentioned SEC here for India. I'm from India, so SEBI does it for India. I'm not sure who does it for Euronext Amsterdam.
I don't know.
Yeah, so you usually have cadenced auditing time frames where they come in and check. But you can also get external auditing services for example, what I mentioned before. These are all types of practices, accounting practices that you have to follow and adhere to when you report numbers. And the governmental agencies basically can ask you to, they call it a raid in India. I'm not sure how they call it here. If some let's say whistleblower act comes out or something, then usually governmental agencies try to look into the figures a little more closely. They raid in India they call it raiding the company. I'm not sure what they call here, but it sounds as a controversial term, but it's usually trying to understand a little more why those numbers are mentioned there. So as I said, rules for it. US GAAP, this is a word that you will see around, or even IFRS. GAAP is basically general accepted accounting principles, and these are basically metrics. Think of it as key performance metrics that you have to include in your financial statements. And so it can be in Dutch or in English for Euronext Amsterdam, but also if you list it in other EU member countries, then you can also have the financial statement in that particular language. And for extractive industries, you also have to mention the amount of money you're paying to the government. For example, take a random example of a company that does oil extraction. For every amount of crude oil you extract, you pay a certain fee to the government, and that should also come into your financial statements as to how much that contributed. So so this is something that usually is publicly available. You can also go to the Dutch registry and type in the name of the company you want, and you can or you want to see the financial statements for. And for a certain fee, I think you can get the financial statement of that particular company. Usually, it's listed in their websites, but you can also get it through the official ways as well. Yeah. Are we somewhere good here? Okay. So again, now I introduced financial statements. So financial statements is a umbrella term. The three main, let's say, documents that come under it will be cash flow statement, balance sheet, and income statement. Let me start from the left-hand side of it. So income statement is basically a profit and loss statement of the company. It tells you how much revenue you have, what are your operating expenses, what is your earnings, EBIT. EBIT is basically earnings before interest and tax. Does everyone know what EBIT is? Okay, I'm going to assume everyone knows earnings before interest and tax. So EBIT, and then you can also consider other fees that they have to pay, other debts that they have to incur, and so on. And all of that is usually mentioned in your profit and loss statement. And with over here, and this income statement is given until the period of reporting. Until the period of reporting, let's say for when I take the report at the end of Q1, until that particular time, what is my revenue? What is my deferred revenue also sometimes? Deferred revenue is revenue that I didn't account for in the previous time, but I'm now accounting for now. These are all parts of income statements. Until that particular point of time, how is my business performing? Okay? And cash flow statement, basically cash flow statement can be taken in times where you can, let's say, withdraw the statement at a certain duration, and then you see from where the money is coming from and where it's going. How much is going into the reserves of the company, how much is going into its expenses, how much is going into debt payments, where is the money coming from. These are all cash flow statements. And this more or less assets can pay you, but your fixed assets will usually be shown in the balance sheet. Is there something that, think of income statement as a movie of the company, and balance sheet at the end is something like a snapshot. Does it make sense? Like at this particular time, if I have a long-term time period, this particular time, I can take the balance sheet and see the assets, liabilities, and the equity of the company. We know what assets and liabilities are, right? Basically, assets are something that appreciate usually over time, and liabilities are something that you are give off in some way. Maybe you have a better definition.
It will help if once you show examples
Yeah.
of a balance sheet and income statement, then.
Yeah.
But the one kind of like the relationship between them is like if you want to move from one balance sheet to the other.
Yeah.
You do it through an income statement, so that gives you all the information that you need to explain how we went from a balance sheet in 2023 to a balance sheet in 2024. All the information is in the income statement.
Yeah.
One question is maybe not very relevant to this specific slide, but more relevant to previous slides, is about the timing of these financial statements. At what periods the governmental organizations such as tax office expect companies to release this information? Is it can a company choose to provide financial statement, for example, for tax purposes on yearly basis, or it should be quarterly basis?
So yearly basis you have to. As I said before, fiscal year, right? Every company operates in terms of fiscal year.
Yeah.
So I think fiscal year starts in April 1st, or how is it in Europe? Do you have an idea? So the calendar year is January to December, but fiscal year starts usually in April, and then goes until the next fiscal year, which is April 23 to 24. And then once your fiscal year ends, usually within duration of 4 months, you're supposed to release an annual financial statement.
Okay.
So that's your overall. Basically, it tells you how you performed in the previous financial year.
Okay.
Quarterly is for that particular quarter. How do you perform? And quarters 2.5 months. So within that, I'm not sure if companies should also report quarterly earnings. Is that also a regulation with the I don't know. I'm not sure if that's if they have to report quarterly earnings as a mandatory.
Okay.
but they usually every 2.5 months. They also have once they report quarterly. Yeah, so after an earnings call, you have a quarterly report usually.
Okay.
And yeah.
Yeah. Okay. Thank you.
Yeah, so that part I need to check myself because usually companies report quarterly results, but is it mandated is something I need to check myself. Yeah. And as he said, sometimes market behaves based on that particular quarterly report. Markets do behave at that particular time a little differently. So we need to also sometimes take that into account. Yeah. So balance sheet, as I said, is a snapshot. In that particular time, what is happening with the company finances. The way it is calculated usually is the summation of assets should be equal to the summation of liabilities and shareholder equity. So this is an accounting way of basically saying, if I add something as an asset, if I add something as a money, I don't know, like a loan I'm taking as an asset, money is coming into my place. Then the interest that I have to pay is a liability. So it has to balance out. The money that you pay, the money that you get in, has to be balanced out in terms of liability. And this is fundamentally how it's used, and what comes under assets is basically cash in the bank. How much of money do you have to pay your obligations that you have to pay? And current assets are basically assets that do not, like within a period of 1 year, you can liquidate it. Non-current assets are assets which takes you beyond 1 year to liquidate the amount of money. This is more or less. You also have fixed assets. Fixed assets could be a company investing in, I don't know, securities, for instance, and their own investments as well. Companies also hold stocks in, I don't know, let's say if you're a customer company, you can hold a certain share in your supplier as well. That's normal to do that. But yeah, these are all your assets. And then your liabilities. Your current liabilities is accounts payable. To the supplier, I have to pay some amount of money because I waited for my revenue to come, and so on. Then your short-term debt, short-term line of credit and long-term line of credit is usually given to companies. Short-term corporate debts that comes in, and long-term debts that you took over, let's say a period of 5-6 years, those also come under your liabilities. And your shareholder equity. Equity is the amount of money that they have given and how much you hold as capital. And you basically give out earnings per share sometimes. And you have a return of their value, right? So this is your liability. And asset minus liability will give you the net worth of the company. This is how companies' net worth is usually capitalized. Given. Yeah. So also sometimes tax credits for sure. We get based on the government policies to stimulate a particular market segment. They usually also give tax credits. If you, for example, I can give you an example that I know of in India. India came out with a policy when they did startup, they were calling it Startup India, where for the first 3 years, you do not have to pay tax if your revenues are below a certain value. This is not tax credit given to you, but this is what you're gaining on what you could have paid at the end of the day. You can also get tax credits if you make for instance, every research investment you make, a certain amount of tax is refunded back to you. So you're getting the money at the end of the day back. This is also mentioned in your balance sheet. But as it said, it's for that particular time. Probably you're going to get more in the future. probably you're not going to get more. But the balance sheet has to balance out at that particular time. If it doesn't, then accounting has made some error somewhere, usually. So if you take a standard balance sheet, which I'll show you in the next slide, the total of the assets will always be equal to total of liabilities plus shareholder equity. Yeah. So just a little more detailed from the workshop that I attended. The three key financial statements. Yeah. Is there any questions by now? Someone have? No?
Is the shareholder equity like the value? Is the shareholder equity the value of the company, like the market cap? Is that it? From your expression of what is it? The company's net worth is assets minus liabilities. Okay.
Is the shareholder equity is usually the amount of floating shares that the company has given out, right? Company can also retain a certain amount of shares, which will come under assets. Usually.
Okay.
But yeah, you're right. In terms of but market capitalization, is that different from? That is completely different from that. Can you maybe explain to me what is market cap and difference between net worth and market cap?
So the actual equity would be the book value of the company.
Yeah.
But the market cap is what the market thinks it's worth. So
Yeah.
there can actually be a very large discrepancy.
Yeah.
That's also what I mentioned earlier, like price to book ratio.
Yeah. So you do revenue multiples to get your market cap.
Sorry?
Right? You add some multiples to your overall.
That's what the market thinks.
Yeah.
So they might assume that the future growth of the company has a lot of potential.
Yeah.
So they will value it higher.
Yeah.
Because as you said, these statements are a snapshot of history, but they don't tell you much about the future. And that's another part that we're not going to talk about it, but it's another part that's also very important in fundamental analysis, is to understand the future cash flows of a company.
Yeah.
And once you combine that with these financial statements, then you can properly assess the value of a company.
Yeah. Do you have? I have an example of my company, but do you have an example of any company in the Netherlands in terms of market cap? Do you, out of your head?
I have some links, but it's kind of difficult
to
talk about it without showing the whole picture, because there's a lot of information there.
No, I mean, I understand. So market cap is a little different from. So this is an example of a balance sheet, which I'll try to walk through it. Can I zoom in here? Sorry. You guys know how to zoom in this here? Or is it readable from here already?
You can read it for us.
Sorry. So as I said, I'll probably try to come here. See the frame. So assets are split into current assets and non-current assets, right? And in terms of current assets, you see cash and short-term deposits that came for this particular balance sheet.
So what's the difference between current assets and non-current?
So current is something that is expected to be converted in cash less than 1 year. You hold some amount of, how do I give an example of it? I'm giving let's say, for example, a very random example is gold. You can convert gold into cash within a year. But securities, for example, you can't. I'm not, again, I don't know if companies invest in gold. I personally don't know, but I'm just giving you an example of that. And
for example, if a company has a building, is it also counted as an asset in the balance sheet?
It's a fixed asset.
Yeah, okay. And it is counted as of course, something that cannot be converted to cash within 1 year, right?
Yeah, so property, plant and equipment comes under non-current assets.
Okay.
So the equipment that you own is also something which is an asset at the end of the day. And see, loans receivable is also an asset. So that's why I'm saying, like, it is loan at the end of the day could be a liability, but loans receivable is an asset for you at that particular point of time because you're getting money, line of credit. So I'll come from current assets. First is your cash inventory. Cash inventory is the amount of money that you have already. This you could have generated by your own operations or investors pooling in money into. That can also be part of your inventory. Then receivables and prepayments. Receivables and prepayments, accounts receivables is usually if you have, let's say, a high value product that you're trying to sell. Strategically, the payment will happen. Let's say you're expecting the payment to be delayed before this balance sheet was withdrawn, or let's say there is a payment that is coming in that you made the sale already before. Then it's sort of accounts receivable. And prepayments as well. Like if I want to reserve a particular, if I want to get, let's say I have a huge contractual agreement with someone and there's a certain portion of prepayment that's coming to me because of this contractual understanding I have with them. That's also part of my prepayments. Then cash and short-term deposits. Short-term deposits, yeah, so they could also invest in extremely short-term securities and withdraw money from it from terms of interest. Then that comes in as your assets. Then your non-current assets, as I said, properties and plants. I'm not sure what investments in associates means, to be very honest. I'm not very sure what investment in associates means. Does anybody have, Peter, do you have an idea?
I don't know.
Yeah, I'm also, that's something that I honestly don't know. But investment securities, that's also part of your non-current assets. Now, in terms of liabilities, there's current liabilities and non-current liabilities.
Why does loan receivable counted as non-current? Because that is something. If I have a loan plan that the bank tells me that they will give me, they usually pay it within less than a few months, right? So why is counted as non?
So loans receivable could be from banks, could be from other financial institutions. And in this particular scenario, again, I'm imagining, so they have $165,545 that comes in from 2019. But your question is, why is it in terms of non-current? Yeah.
The house loan is 30 years, so it's always the short term.
No, when it comes to asset, asset means something is under your control
Yeah.
in your business. So the loan which comes, or even mortgage, it is something under your control. So it should be, I think it should be.
It should be in.
No, but expected to help for a year greater than a year.
Oh, so.
The loan payable come here.
So it's a long-term loan.
So I mean, again, one of the scenarios in which the money could come is that the loan is also financed in different durations of the year. It's how they agree on. So one, you can take a direct loan for a certain amount and pay an interest on that, or you can say I'm financing it over the couple of years, and I pay varied interest.
Basically, it depends on the situation of the loan.
Yeah.
The loan that the bank says, for example,
Yeah.
100K, I pay you within 2 months. That is current asset.
Yeah.
Okay.
So usually financial loans can be given by financial institutions, also by independent institutions as well. So the agreements for loan agreements that we as a common man have is very different, could be different from corporate financing.
Okay.
Yeah, liabilities, trade and other payables. Basically, trade and other payables comes under the amount of, let's say, to execute a particular trade, to execute a particular product or service. There are payables that come in between, which is you're vending out your manufacturing to someone. That's also your payable, right? At the end of the day, you have an agreement with him that when I receive my receivables, you will also get a certain portion of it. So that's liability at the end of the day.
Suppliers need to pay.
Yeah. But your suppliers is not, it depends purely on that particular agreement. For example, you can have a long-term agreement with the supplier where you're saying once I receive my accounts payable for that particular duration, a certain portion of it will be paid out to you. Then short-term borrowings, as I said, you needed to, let's say, for some, again, this is something you have to decipher. Based on, because this is not going to tell you why the short-term borrowing was taken, but you pay interest on that immediately. Short-term borrowings usually have a very high interest rate, and that comes under liabilities. And of course, taxations. And non-current liabilities is taxations which are deferred as well. So you can, for instance, for a certain fiscal year, you did not pay a certain portion of the tax, then you defer it for the next year, then it comes under deferred tax liabilities. And also it's also based on income that you could not recognize immediately at that particular time, but it's still for that particular fiscal year you could not, even though you made the sale, you could not recognize it until it comes into your bank account. But again, taxation would be based on that. So then you defer the tax a little bit.
So what happens to the deferred payment? Let's say we're talking about 2019 and you're getting a deferred tax credit from 2018 and 2019. And how will that be reflected in the statement?
I'm getting a deferred tax credit, right?
Yeah, so for 2018,
Yeah.
you are getting a payment in 2019, it's a credit. So how will that be represented will that be represented 2019 under the 2019 column or in 2018?
For tax credit, yeah, I get your question. It has to be mentioned, if you're mentioning it as a liability that you eventually have to pay, then you have to mention it as an asset in terms of your credit that you're going to get because of it, right? Only then will it balance out. So in 2018, I got a certain line of deferred tax credit, is what you're saying. I didn't pay tax for 2018, then it should eventually come into my asset, right?
Yeah.
But it will also show up in your liability, in your long-term liability as well. Because your long-term liability at that particular point, you need to pay for it. Does it make sense to you?
Yeah, I mean it's credit, so the tax authority has to pay you some credit.
Yeah, but you can also not, deferred is usually what you don't immediately recognize at that point.
So it's still considered under 2019. If that comes from a previous year, it will be put under 2019.
Because you're deferring it for a particular year. It comes under 2019. And then again, this is assets and liabilities. Now we'll come into equity. Equity is the share capital that is whole entire value by investors equated into dollar. Of course, the amount of reserves they give out, and then the money that is basically allocated to that particular share comes in as share capital. And then capital reserve. This I'm also not 100% sure of what capital reserve is, so I have to be very honest here. And retained earnings, I can tell you about that. Usually, the amount of I think shareholders, when you own a particular share, you get amount of, let's say, amount of money that comes with, let's say, earnings per share. Let's put it that way. The earnings that you retain has to, at the end of the day, a certain portion of it has to go to the shareholders, and that's, I think, what is mentioned in equity. Does it make sense?
Wouldn't that be like returning dividends or something?
Yeah. At the end of the day, you're returning dividends. So that's why it comes under equity.
Oh, okay.
Yeah, maybe there's something we can check afterwards, but I would think these retained earnings are after the dividends have been paid out.
Yeah. So.
And after the share buybacks.
But it shouldn't. Then it should come under an asset, right? rightfully.
Would be a liability, yeah.
Yeah. So let me, okay, again, I'm not 100% sure of it, but I can check it for sure.
But it's also, yeah, it's going to be visible in the cash flow statement.
Yeah. So the next I want to go inside is profit and loss statement.
Sorry, can we go back?
Yeah.
I wanted you to finish to ask a very fundamental question. How the magic of, first of all, this balance sheet finally should be balanced, but is it in this example, do we say, maybe it is not a complete example, because you don't, okay, yeah.
You see total assets there, 17 million,
Yeah,
778, 979.
Yeah,
It's
exactly.
balanced exactly with 17 million, 778, 9.
So my question is about the magic of balancing, how this balancing is happening. For example, if we have asset, for example, property, where property is reflected in liabilities or in equity. It is kind of, when it comes to this balance sheet, this is something mysterious to me, because any number you see in one part, you should expect some negative values on the other part, but it's difficult to follow it, basically.
Yeah, I get your point. Again, here I have to think in this particular scenario, in this particular example that they gave, how a property.
Also explain it with an example of a house that
Yeah. So the property value is mentioned as an asset.
Yeah.
The money that you use to finance the property comes in under liability.
But that money maybe have been for example, if I buy a house today and this is my asset, and if I owe to bank the same amount of money, that is my liability. But what if I am not owing anything to the bank anymore?
Then your equity is equal to the value of the house.
Yeah.
So it comes then in equity. Equity, yeah, okay. But I expect it to be in the same terms. For example, because if my asset is property, then in my balance sheet I also write equity property. But what I see in companies' reports, for example, especially in this report, you have property, but you don't have anything, any nomenclature, let's say, that represents the same concept in liability or in...
You have like the short-term borrowings and the long-term borrowings.
Yeah, borrowings, yeah.
So in this case, probably the guy is still
They
paying
owe
for...
money,
Paying, yeah.
Yeah, okay.
So you can't, as I said, you can't decipher.
Okay.
But yeah, also maybe a learning for me is that if the property appreciates over time, and I think all billables are done, then comes under equity, is it usually?
And will that be like shareholder equity? Like
That's a question I don't have an answer to. I'm not sure. Probably anyone else in the
So, for
audience.
example, an example that maybe you made a good point. An example is that you have you bought a property by loan, and your property is like you bought it for 100K, and you owe the bank 130K with interest and all of these things. But in a year, the value of your property becomes 200K. Okay, so probably part of it becomes a liability, that 130, and the rest becomes equity, right? Yeah, okay.
It goes up,
Yeah, okay.
Yeah, so again, it's also a new learning for me that equity, fixed assets play a huge role in terms of the equity of a company as well. It's a new learning for me as well. Okay. Yeah. I want to move to income statement now. This is the second, this is what yeah. So income statements are usually, this is a good assessment to check profitability of a company. Income statements, how they are generated. This is basically equations, and I'll go through it. First is your sales revenue. You're selling probably a good or a service, your goods or services, and you're getting a certain revenue out of it. That comes under sales revenue. And then you subtract cost of sales from it. Now, cost of sales, what does that mean? Cost of sales is your for you to deliver that particular good or service, how much amount of cost was involved in that particular time. So there was probably shipment involved in it, probably raw materials, labor usually comes inside it. And these are all costs, and also probably you're taxed for it. You're going to add, there's some levy on it, let's say import tax. These all comes under cost of sales for that particular goods and services that you're selling. Gross profit is basically the sales revenue minus the cost of sales I had, then I get my gross profit. A very simple example is I'm selling this bottle. I am selling it for, I don't know, 2.3 euros, 3.9 euros or something. And then I have a margin that I basically make out of it. Because out of the 3.9 euros, I'm paying, me as a consumer, I'm paying for the ingredients that was in it, the manufacturing process, the plastic bottle, the freezing and all of that. I'm paying for all of that. And then on top of that, the manufacturers, so they also make a certain margin of it. So this gross profit.
Just at this point, the difference between cost of sales and operating expenses are not clear to me. Can you make it?
I'll come it.
Okay, yeah.
So this is gross profit. Next, when you subtract operational expenses. Operational expenses is the amount you pay for HR, because they are extra value added services. The amount of money you pay for marketing. See, because you don't market, you market, let's say I'm funding a marathon.
Yeah.
And I'm paying a certain amount of money to fund my brand there. I could choose to sell a certain product there. But when I make the sale of one particular bottle there, this cost is not, this marketing cost was not accounted for when you paid for this. But it will be accounted for in the bigger picture of the company. Does that make sense for you?
I would say marketing could be also cost of sales, isn't it? Marketing isn't, for example, you pay a TV to advertise your product.
Yeah.
This can be cost of sales. I'm not sure, but I want something that really differentiates between these two. Yeah.
For product marketing, for marketing a particular product that you're selling, I would agree to you that it comes under the cost of the sale you make for that particular product. But if I'm marketing my brand outside of, I'm using another instrument to market my brand. I don't know, like a T-shirt on sports, like a name on a sports competition. I don't know, like a World Cup or something. That comes under my operation expenses, because I'm marketing only my brand there. I'm not marketing the product I'm going to sell there. That comes under your OPEX.
Okay.
What really separates this? Like, how do we define these are necessary expenses which you put under cost of sales, and these are extra services which is operating expenses?
So let me finish operation expenses definition, because this is usually my understanding of it, and what determines, I'll come to that. So operation expenses involves rent, your insurance that you're paying, some legal fees you're paying, the utilities you take for the office, everything comes under operational expenses. And operating income is basically your earnings before income tax. Now, your question that you asked, in terms of what determines the cost for that particular product, the pricing is set by usually by the business owner, and he takes into account what goes in for me to make that particular product. So it's a differentiation that he has to bring in. For example, if I am paying utilities to use the tube light of a particular, I don't know, like paying electricity to run the office, but the office at the end of the day is producing something different, then for me that's not a direct cost linked to the product. A direct cost linked to the product would be, hey, I'm paying for the water and the water is being used in my product. That is a direct cost that is involved in my product.
So basically, cost of sales is very direct toward the product, And operating expenses is all other costs of the business, which
Yes.
is not dedicated directly to that specific product.
Which is why you subtract it from the gross profit.
Yeah, okay.
Because when someone says, "Hey, we have gross profit of so much," no, it's not. I'm not. Sometimes, and I've seen this again. I'm not sure if it's completely financially correct. Turnover and gross profits are usually
Interchangeable, okay.
used. But what is your net income at the end of the day is somewhere way below here. Do you get my point?
Yeah.
So again, this cost of sales is set by pricing, and we as a market also have enough power to put pressure on the pricing because of competition, right? That's also something that comes into play. And then operating income is earnings before interest and tax. EBITDA earnings and earnings before this earning will tell you, by running my core business, am I profitable or not? Regardless of what is my financial situation, how I got my financing, how all of that, because all that comes under interest, taxes and everything. Regardless of all of that, if I use operating income, is this a profitable business or not, is something that EBITDA will show you.
Can I bring an example just made up in my mind, and you tell me each of these costs which goes on their sales revenue and which
Not part of the pricing committee, but I'll try. I'll give my best. I'm not part of the pricing committee, but I'll give my best.
Yeah. Just your idea. We can have a discussion, group discussion here. Everyone can has an idea. Assume I have a business who buys this mobile from people and sell it to the people. Then I should make an appointment, and I am an online business, let's say, and I should make an appointment with a person. So I fuel my car to buy this, basically. I fuel my car, I travel to, for example, Utrecht to buy this from someone. This cost of going to Utrecht by train, for example, or by my car, is 30 euros. Is it cost of sales or operating expenses?
So I'm asking you here, are you the business who's selling the phone, or are you a different business?
I am a business that buy this from people and sell it to people.
Oh, okay, so you're in the middleman.
Yeah.
For you to operate, because you are selling a service at the end of the day.
Yeah.
For you to execute that particular service, the cost for you to involve, the cost it takes for you to move to go to the supplier and come back, or probably, I don't know, procurement cost is, I don't know if procurement cost comes inside that, but in my definition, I would put procurement cost, the transportation cost comes under procurement cost, because you don't have any raw materials to execute.
And procurement cost is operating.
The train.
Huh?
The train.
Yeah. It is OPEX basically. You say
it's cost of sales.
Okay, cost of sales.
Because
procurement. Yeah. Okay, and then I pay for the phone itself to the guy, and that is also cost of sales.
It's cost of raw material for you.
Yeah, and then when I am back, I sell it. I make the same travel to sell it to someone in Rotterdam, for example, and again it's cost of sales.
That's delivery cost.
Yeah, which is cost of sales.
Yeah.
And then I get the money, and this money becomes
your what you say. Let's say your phone is 800 euros.
Yeah.
Let's just give a random example.
Yeah.
Phone is 800 euros. The transportation cost is around 150 euros. Yeah. You're paying 950 euros. I don't know how you price your product. You also want a margin on your product. Let's say you say 1,000 euros.
Yeah.
Then the gross profit you make will be 1,000 minus 950, which is your 50 euros.
And so basically, in this example, nothing goes under operating expenses.
But your operating expenses, which is outside of it, is your train subscription that you pay for.
Okay.
Your
probably website subscription and like hosting costs and these things.
Hosting costs. Also, over here, I'm not sure if your salary also comes inside that. But let's say you have another person to execute this for them. If you have another person that you are appointing as here, for you that's labor.
Then
that comes under
labor also is OPEX, right?
No, labor comes under cost of sales.
Ah, okay.
Because for you to execute that service, you used labor as a cost.
Okay.
But for you to maintain accounts of all this sales that you have made, you need a HR or an accountant over there. The money that you pay to the HR accountant comes under OPEX.
I think it also depends to define that what is what I am selling, because if I am selling a product,
Yeah.
if I define everything's directly related to this one based on your explanation, and I recruit someone, I would say that that person is not directly linked to this phone. If you define a service, yes, it is directly defined to the service,
Yeah.
but not to this product. So still, the question
But
of
you at the end of the day, being a middleman,
yeah,
is a service company.
yeah, okay,
You
yeah,
know, the product, if you want to charge it based on the product, because if you want to charge it based on your product, the product at the end of the day is a raw material for you, right?
yeah, yeah,
Because
okay.
you don't know what is involved in the manufacturing of it and so on. It is a raw material for you.
Ah, yeah, okay, yeah.
So then, in terms of executing the service, you need a certain amount of money that you pay to the labor and everything executing all of this. That comes under your cost of sale, because you made the sale. For me as a consumer, I'm buying this purely because of convenience. I don't have to go to Utrecht, and I'm in Rotterdam. I don't have to go to Utrecht and then buy it for me. Someone else is doing it for me as a service. So then I pay for that service, and this is the cost it takes for you to execute that service. But everything that goes outside of it, which is, I don't know, like if I say
So this way, basically, my website also is just to execute that service. So the website also doesn't come under OPEX, it goes under cost of sales.
No, but but for that particular service that you delivered to me, it's not directly linked. The website, money that you pay to maintain the website, is not something that I directly pay for. Through the gross profit margin, probably
okay.
indirectly I pay for it.
Oh, okay. Okay.
Does it make sense?
Yeah, okay, yeah.
Yeah, why should we care about whether it's cost of sales or operating expenses? In the end of the day, it's still a loss that you're making for that. Is there?
You
Why
as
does
a
it matter?
consumer or you as a
As the business.
As this owner.
Yeah.
Should we care?
Yeah. Why do we care about separating?
So as you as a business owner, your entire game is to make sure your net income is profitable.
Yeah.
You cannot avoid certain costs that comes when you drive a sale. So you let's say labor cost, inflation. It is something that is market driven. You have to charge it back to the market in some way, right? So for you as a consumer, you can probably optimize your processes better to involve lower labor. For you as a businessman, it'll help you understand which bucket do I need to optimize where. See, because this is what the consumer pays for at the end of the day. The consumer is indirectly paying for this, but your direct payment comes from here. So you have an opportunity there to reduce the load on the consumer, directly reduce the load on the consumer. Indirect expenses, for example, like marketing expenses that comes indirectly. A certain brand name will charge you a lot for a certain t-shirt versus another brand name that doesn't charge you a lot. Cost of even though we're buying the same t-shirt from the same, he manufactures it in the same way and so on. There are other expenses that he does outside of that sale, like the quality checks that he does, the branding that goes about it and so on. This is the cost that you have to bear in terms of the brand. But he knows that, hey, I have optimized as much as possible here. He or she knows that I've optimized as much as possible here. Does it make sense?
Okay, so it's basically to know where to optimize things, where to cut costs if possible.
Yeah,
okay.
because
Also, this is the expectation of tax organizations to bring, because in financial terms, at the end, gross profit has its own definition, operating income, EBIT has its own definition, and by shifting things upper or lower in this category, these numbers will change. So I think it's important to investigate exactly what terms go where, but sorry, I forgot your name. Shashank said it should be, someone should really think what is its product. Is it, for example, when in my example, is the phone the product, or is it my service a product? which I define as the product, and the things that directly link to that product or service, which should be defined, goes under cost of sales, and things that look more general and is not directly linked to that service or, let's say, phone, that could come on operating expenses. Still, to me, myself, if my activity, if my website is only dedicated to this type of service, which is going to buying an old phone from a guy and selling it to another guy, and if that website is dedicated only to this activity,
You would charge it back to me in some way or the other.
yeah, I mean, it should be more toward cost of sales than operating expenses.
Yeah.
But yeah, I think it's an open question. We can.
It should be under your operating expenses.
No, but he's saying the website purely is existing for me to open an account there and start the service just for this service. But I'm assuming you don't have.
It's a personal, let's say, website for that company.
Yeah.
But that company, its pure service is to buy second-hand, let's say, phone and sell to the people. Let's say. Assume this is just an example. The question is why we should bring it under, for example, operating expenses, because this is directly linked to that service that I am providing.
And who's going to make this website? Yeah.
Sorry.
Who's going to make that website?
Maybe me or someone else.
But does that have anything to do with sales? Making of the website?
So how you define it? It should have something.
So actually the creation of the website is an operating expense.
Okay.
But I think we shouldn't linger that much.
Yeah.
Maybe we can come back to it in the Q&A. But
Yeah.
Yeah.
Yeah. So
Where does R&D cost comes in?
operating expenses. Your labor directly involved in the production of the production of it. Again, R&D will make a split right inside it. There'll be projects which research usually comes under operating expenses. Let me put it that way. Development, again, it could be the amount of development effort spent in making that particular product will come under labor cost. Then, again, earning before interest. This is interest and tax. Taxes are something, of course, and interest if you have some amounts of short-term borrowing or long-term borrowing for you to execute that particular, for you to execute your business and so on, that comes under interest and taxes. I don't know, I financed it through a bank. That's purely out of the scope of my business, right? My core business at least. And that all comes under interest and taxes. Some people also put depreciation over there, some people put amortization over there, EBITDA. These are all different buckets. But GAAP as such, I don't know if EBIT is considered in GAAP. I haven't personally seen EBIT come inside GAAP. But it's a good way of assessing profitability and your net income at the end of the day.
Can you repeat the definition of interest here? What is interest?
The amount of money, let's say if you, for example, the service that you said, you're taking money from a bank to pay your employees, and you have to pay interest on those.
Okay.
That's basically comes under interest.
And if you're like a finance company and you get interest, where does that come?
That comes under your sales revenue.
Right.
Because your product that you're selling is, at the end of the day, a tool that you're earning. Okay? Yeah. So now cash flows. Cash flows is something, cash flow management is basically the orchestration of what we just spoke about in the past. So you have your operating cash, which is the amount day-to-day expenses that comes under the operating, let's say, cost required by the company. Also operating day-to-day expenses, also day-to-day money that you're earning back through operations. That also comes under operating cash flow. And investing as well. Let's say as a company, I'm investing the cash given to me into another, I don't know, startup. Or I'm putting the cash, I have a lot of cash with me, and I'm putting these reserves into a bank in some interest that I'm earning. That's the cash flow that went towards investing. That's the cash that you spent on investing, which will later could become an asset for you, or if it depreciates over time, then it can also lead to it to being a liability. And yeah, you also have financing. Companies finance other companies, companies raise money, companies pay their debts, companies also pay their shareholders. These all comes under financing. It's how basically the three elements of cash flow statements are your operational costs involved, operationally where you're sending where money is coming in and where's money going out. Investing, as I told you, is the amounts that you're putting in different modes of investments, mediums of investment. And third one is financing. And of course, financing is purely money that is owed or money that is given to, let's say, a supplier for him to, I don't know, for him to grow his capacity. By you financing your supplier in a certain way, you're also getting a certain amount of shares from his company. That also comes under financing, right? Because at the end of the day, I'll still ask him, I could finance a loan to him, and I could ask that back in terms of with interest. So this is purely cash-based methods in which we finance in which we finance other suppliers as well. So I honestly don't know where the line is drawn between investing and financing. This is something that I need to delve a little deeper. But from the outside of it, this is what cash flow statements usually contain.
I see amortization is not included, so where is it included?
I honestly don't know
You
amortization.
can usually see it in the income statement.
Okay.
It was not mentioned, but you will find it.
But can
So-
someone explain amortization to me?
Yeah, Shashank mentioned the EBIT.
Yeah.
But you will also very often see something called EBITDA, which is the depreciation and amortization added.
Yeah, can you quickly explain amortization to me? I honestly don't know amortization.
For depreciation, I think I understand what it is. So
Yeah.
once you buy, like, let's say a truck,
Yeah.
it loses value over time. So maybe after 5 years, this truck is kind of worthless. It has so many issues that you need to buy a new one. So that's what they call depreciation.
Does IP also depreciate? Or not?
Intellectual property?
Yes.
No. Intellectual
does.
property, how does it if your competitive position if your position of the IP is either expired, if you forget to renew your patent,
So if it can expire, then it depreciates over time.
if you're continuing to finance it.
It might also just lose value.
Yeah, exactly.
You might have
It
like
can.
some kind of a, let's say, neural network model that's super hot
Yeah.
today, but then 2 years
Exactly.
now it's like
Completely,
because
yeah.
there's 10 times better models available.
Because basically about these things, they don't have a standard price. Market should define their value. You put in your financial statement the value that market put into that product or in that innovation one day, which is not same as 10 years later.
I think you brought up something really interesting that for me personally is a discussion point. I do want to bring it up.
And for amortization, I'm not sure, we can check, but I think it's a way to kind of, if you make like a big purchase for a piece of equipment, and instead of putting like $1 billion in one statement, you can split it over maybe 5 years, and then it's kind of visible in installments.
So if you buy a house, it's actually amortization of the house.
Yeah, you're kind of repayments to the bank, yeah.
Yes.
But it will be visible, I think, on the cash flow statement, the actual purchase. But on
Yeah.
the income statement, you see the installments.
But depreciation will be then like an expense, like a loss.
Yeah.
I'm mentioning a discussion point that it's surprising me, and I also want to keep it up. As I did think about it when I made the slide, which was, let's say there's a legal case, and I won the legal case. with a competitor and I now am payable a certain amount of money. Does this come under this profit and loss statement?
You won the legal case.
I won the legal case.
And you have proceedings from
I have proceedings from it, which is payable by my competitor or whoever at this place. Does this come under my profit loss statement?
If you're like a troll company that buys patents and sue people, yes.
Yeah, but it's not a profit or a loss, right? It's not a profit
I
in
would
its.
say it doesn't come here. This is my idea. I'm not sure, but I think it's more about it goes more into assets.
Yeah. It'll also reflect in my cash flow statement. It'll show up in my assets, but it won't show up in my P&L statement. So which is why again, I honestly don't know where it lands.
Possible, yeah.
Sorry?
It has to show up in the income statement.
Oh, but it's not linked to the execution of my business.
But it's non-recurring income.
Should it show?
I mean, you have to, if it's going to show up in the balance sheet, then it has to show up in the income statement.
Because
Then
you would have gone for a case. You need to hire lawyers and other things to represent.
yeah, in my balance statement it will show up.
Yes. Then whatever is coming, you have to also.
But will it come in my income, in my P&L statement?
I would say yes, yeah.
Oh, but
It
then
should be, yeah.
But
But it will be a category that we didn't see.
it comes
But
under.
I'm sure there is a category for that, yeah.
Yeah. So then
But it's not something that's normal part of your business unless
Yeah.
you're a litigation company.
No, I mean you don't have to be a litigation company to earn.
But you could be like a lawyer business and it should be part of your
No, for
income statement,
example,
yeah.
the very simple example is I don't know. Just giving a random example. Apple suing some other company for patent infringement, and they won the case. And then now the company owes X amount of $1 million to Apple. It should theoretically show up in my net income because it's a money that I've now earned, and the money that I've paid to get this legal proceedings should show up in my operating expenses. But it's not affecting my core business in any way, right?
Indeed, but I think just by the whole logic, it should show up there.
Yeah. So I think I've seen some companies mention it as, claim it as excretionary costs, excretionary income or something, where one-off incomes, they usually say this is one-off incomes. But honestly, I don't know if you pay tax for it. This is, then it should find its way inside EBIT, right? It should find its way inside EBIT, and I should be paying tax for it as well if I win that particular case.
Yeah, let's look it up after.
Yeah. So, anyways, I was just thinking, but you need a holistic picture always to make a judgment. Yeah. So finally, let's come to the most amazing thing where I started this journey, which is reading annual reports of companies. Annual reports of companies is where you have financial and non-financial information present there. So financial statements basically tell you the overall performance of the company over the year, and this is the cadence that I told you in terms of yearly. And then it also tells you a deep dive into, they also give you notes on how they made these how they made their money basically. And usually it will be a depiction of why they lost money or why they earned money and so on. And management discussion and analysis, usually directors will give you their take on how this business performed. And it gives you a good idea of how, let's say, usually the CFO would write a statement, and the CFO statement is usually also mentioned in the website. You can see how they respond to their statements and how they, let's say, analyze it. And you also get strategic directions of the company, even though it's not something which is important for us per se from a financial standpoint, but it gives you on how the management is going to move, in which direction. Are they going to stay in the markets that they stay? Are they going to let's say they're losing money from a certain direction, from a certain market segment that you see here. But still, strategically, I am going to play in this particular market. I personally feel strategic investors also look into that. But this is something that one can also argue it's also trying to also, if you read marketing, at least if you read annual statements, the first few pages will be a little bit of marketing in there, for sure. But strategic investors also look into it. So one company that really fascinated me was NVIDIA. I'm just curious if you all know what has been happening in NVIDIA.
Stay away from NVIDIA.
Why?
I don't know, it just seems way too risky.
Again, why?
Too big movements, I don't know. It's a lot of speculation, bro. It's like the entire AI boom and like what will really happen, like what's the path forward. Is it sustainable, the growth, or even the current valuation is sustainable?
Yeah.
Or it's like a bubble that will burst? Yeah, it just seemed like a lot of risk. But on the other hand, I haven't read the NVIDIA report or any financial statements.
Yeah.
So,
The reason why it fascinated me so much, to be honest, was outside of in the media you saw the amount of jumps it made, 200%, I think, was past X amount of years. But it has always been a strategic investment by companies to sort of think that, okay, this is an asset that will show fruition in a couple of years. So yeah, I haven't personally fundamentally analyzed the stock price, to be very honest. I would love to do it. Maybe that will also be another exercise for me going forward. But the reason I read NVIDIA's report is because I liked to understand why this is happening. So I have the report loaded.
Why is this happening? Tell us.
I don't, well, I should be charging you for it, but let me, I took 2023's annual report just to play safe. I didn't do 2024 yet, and it's also proxy report only 2024.
Q1 is already out, right?
Sorry?
It's like the year report.
Yeah, 2023's year report for NVIDIA. And I think it's a good exercise for us to understand financial statements from the huge discussion we had. So as you can see, NVIDIA had a revenue of 27 billion on 2023, fiscal year 2023. And gross margin is 56.9%. They've dropped in terms of their margin from last year. And
from the previous year, you mean?
Yeah, from the previous year. But if you see, if you see the operating income as well, obviously that's also gone down. And I'll show you something which I found was which was really showing how I made the initial statement that financially a company might show a particular value, but the market decides at the end of the day how much or how valuable the company is. I'll show you in the next page. But basically they have segregated their markets into four ways. One is the computer networking, which is the data centers. And this revenue is up 36% year on year. The graphics part of it, they're down 25%, which is, they call their Gen AI graphics, the gaming and all of that. And then all other expenses, they classify as something which doesn't involve in my regular products. But NVIDIA also, keep in mind, makes products outside of operating here. They make a lot of AI models by themselves. They make, sorry, it's all tech background. Please, it's just my bias, but tell me if you want to stop me anywhere. But they also invest in creating their own version of ChatGPT. These are all things that they do not bucket under their computer networking and so on. And consolidated, how much it combines. And they've stayed flat, is what they're saying. And operating income, they've clearly said, hey, we are at a loss. This is how we are, this is how much money we're bleeding. But if you see the earnings, if you see the total shareholder return over the last 3-5 years, It is huge. Can someone tell me why?
Actually, I don't want to speak about why this happened, but I think in the last 5 years, a lot of things, even real estate around the world, not 238%, but to, let's say, 180% sometimes, has been appreciated. Last 5 years has been like special because of COVID and monetary policies, I think. But I understand that today is AI world and tech companies which are basically expertised in computing powers, they will appreciate definitely. So that explains it, I think.
But they've been operating in a loss, by the way. Until 2023, they've been operating in a loss.
But that's what we also see in this picture, that the 1 year total shareholder return is negative.
Negative.
But we haven't really seen what happened in
The-
2021 or in 2020. So,
one
there
year
was
it's 11%, but over the last 5 years, it's extremely high. And
the emergence of AI, and there are like we have CPU, we have also I think GPU is called GPU, and NVIDIA is very expertise in that.
Yeah.
That processor is that type of processing system is very useful in AI technologies.
Yeah. I mean, that's you're looking at industry outlook.
Yeah.
But
And
you're missing some information here.
Yeah. Well,
Because we only see the financial report for 2023.
2023.
And if you look at what the total shareholder return is, it also says cumulative stock price appreciation. And this income statement doesn't tell you anything about the stock price.
Yeah, that's exactly my point. The stock price, the fluctuation of the stock price is not purely dependent on income statements alone. And the stock price at the end of the day, I don't know, for the last 5 years, one can argue you lost 46% of, you dropped 8 points from your revenue, but you only lost 11% of shareholder returns, which means that the market still believed in 2023 that this company, in some way or the other, this is my interpretation of it, in some way or the other, this company is worth, this market price is worth it for this company. And they also pay out dividends usually. And we see the amount of dividends as well. And they also repurchase their stock back, right? What they give out with the earnings, they also repurchase the stock, share buyback program basically. And that's something that they've done. So what I'm saying is, this was an example that I picked out just to say that, yeah, like financial statements for a particular year, snapshot it, or even balance sheets or even cash flow statements, you have to build a holistic picture around it. And these are all inputs that you give to the financial analysts take as input. And then they project as what you think is the stock price. But at the end of the day, it is what you think is the stock price. Market also plays a huge role in it. And yeah, this was an example at least that I saw, which made my statement. Yeah. I think I took more than my time.
We're almost out of time.
Yeah, sorry. But yeah, that's finally my slides. Yeah, thanks.
Thank you very much.
Yeah, thank you.
Thank you.